Canada housing market boom, bust and reality with data. What will be covered? Housing prices, population, immigration, rents, mortgages, taxes, interest rates, and key events. Why it's important, Canada's housing price and affordability depending on many other factors or data. These are the key data trends from the past decade that influenced housing prices. Population growth. Demand side, Canada's population surpassed 40 million by 2023 and was over 41 million by 2024 to 2025. Immigrants, temporary workers, and students all need a place to live, and they usually start by renting. When the rental market heats up, investors step in to buy homes for rental income and long-term equity. Later, as immigrants gain permanent residency, many become homebuyers themselves. Since it takes years to build new homes, housing demand often grows much faster than supply. Condo sale prices per square foot increased, and prices for other housing types, such as detached and townhomes, also rose. Even though home prices per square foot jumped with strong demand, replacement costs rose more gradually and evenly over time. What house replacement cost includes construction materials, lumber, concrete, steel, drywall, roofing, labor costs, trades, contractors, building permits and inspections, design, engineering, and compliance with current building codes. Basic finish similar to the original home. Rising population and immigration levels. Increased rental demand, leading to higher rental costs. Mortgage costs rose as a result of both higher housing prices and adjustments to the Bank of Canada's interest rates. Property taxes also rose because they are calculated as a percentage of housing values. In some cities, officials took advantage of high demand by increasing the property tax rate. Maintenance fees are not tied to housing prices. They generally increase at a normal pace due to inflation. The Bank of Canada kept interest rates low for many years, encouraging buyers to purchase or sign contracts for new homes up until February 2022. When rates increased rapidly, many homeowners faced unaffordable mortgage payments on properties purchased 4 to 5 years prior. Canada's housing market has seen massive swings in recent decades, from strong growth in the early 2000s to a pandemic-era boom, to a recent correction. Population growth, especially through immigration, added significant demand pressure, but interest rates and government policies have also played huge roles today. Affordability remains a core issue. Many buyers who purchased homes in the last 5 to 8 years are now facing significant challenges. Those who bought new pre-construction homes 3 to 5 years ago may no longer qualify for a mortgage at current interest rates, while their properties are now worth less than what they paid. Investors are struggling with negative cash flow due to high mortgage rates and elevated purchase prices. At the same time, rental demand has declined because immigration restrictions have reduced the number of newcomers. Combined negative cash flow, lost equity, mortgages exceeding home values, and higher interest rates. These factors have reduced overall demand for housing. let's revisit some basic fundamentals that influence housing demand and affordability. Population growth increases housing demand. As more people need places to live, demand for homes rises. Growth in temporary immigrants boosts rental demand and often increases investor activity as more rental units are needed. Higher mortgage interest rates raise the cost of homeownership, making monthly payments less affordable for buyers. Demand will go down. Now, let's see how these factors play out in real life by looking at sample homes with different square footages. Let's analyze the numbers for a 500 square foot condo and break down what the data is telling us. First, look at column F, condo price. In 2015, the average condo price was around $300,000. Prices peaked in 2022 at approximately $525,000 and have since declined to about $425,000 today. Now refer to column O, which shows how condo prices move up and down in relation to bank mortgage rates. Approximately prime to 0.5% as borrowing costs increased, affordability declined and prices adjusted accordingly. Second, focus on column A, total cost of ownership. Including principal payments, 10 years ago, annual cost of ownership was roughly $19,000. Today, that number has increased to about $32,000, driven by both higher home prices and elevated mortgage interest rates. Also note column S, which shows the required gross household income to qualify for a mortgage, based on a gross debt service (GDS) ratio of 39% of gross income. Third, review column U, cost of ownership excluding principal payments. This figure represents the true cost of owning, since principal payments are effectively forced savings or equity building, not an expense. Compared to 2015, the cost to own the same 500 square foot condo has nearly doubled today, even after excluding principal payments. Fourth, compare column H with column U. This comparison shows the rent versus the ownership cost, excluding principal for 500 square foot condo. The difference between renting and owning. In 2015, renting was more expensive than owning. Between 2022 and 2024, renting became significantly cheaper than buying a condo. More recently, the gap between renting and owning has started to narrow as rents rise and ownership costs stabilize. This shift is especially important for investors, who typically seek positive cash flow when renting is cheaper than owning. Investor demand naturally declines, directly impacting condo prices. Let's analyze the numbers for a 1,000 square foot condo and numbers for condo price, annual numbers for the rent, mortgage, property tax, maintenance, total cost of ownership, required gross income, rent versus owning difference. These are the numbers for 2,000 square foot condo or home. Trend is same. As we wrap up, these are the big questions everyone is asking. Can policy changes really improve housing affordability? Is immigration part of the solution or part of the problem? Will interest rates stay the same, go up, or come down? Will housing prices fall further, stabilize, or rise again, and when? And how long will it take for prices to return to their 2022 peak? The truth is, no one has a crystal ball. The housing market is influenced by many moving parts, and outcomes depend on economic conditions, policy decisions, and buyer behavior over time. What we can do, however, is understand the data, manage risk wisely, and make informed decisions based on facts, not emotions.